Accounting cycle, adjusting entries.
Let's look at these adjusting entries that we're supposed to cover this week. So if we closely look at this past example that we have successfully completed, we have here entries such as unearned revenue and supplies that need to be addressed. These are the original entries that we have entered with the help of our original source or primary source documents, such as invoice maybe, purchase order maybe. So these entries have been done when they were triggered by documents, primary source documents. But these are also those entries that need to be addressed by the end of a certain period. Let's say the supplies are responsible for what we provide as a service. So I don't remember what this example was about, but they provide some kind of service to customers. So let's say that if it was a printing company, the supplies would be, for example, paper and maybe ink, right? So these are the supplies, but once they are used and provided as a service, we need to sort of report the reduction in those supplies. And in case of the unearned revenue, that would be, for example, originally in somewhere here, we receive $4,000 in cash in advance from a customer for service that has not been provided yet. But eventually, at some point, at the end of the period, this or part of this unearned revenue will be earned. So we have to also reduce this one and transfer it to the earned revenue account and reduce this account or our liability in the shape of the unearned revenue. So these are the adjusting entries that we will address. These are the entries that we will talk about. That's not only this one. If we go, so I mentioned unearned revenue, supplies, but there are also, let's see, prepaid rent as well. This is a revenue that that is the account that also has to be addressed, because although this is a prepaid rent for now, this was triggered by payment of the rent, but then once we start using this rent, using it up, we will have to make adjusting entries to close up this prepaid rent. The same goes for prepaid insurance. If it was, so let's see, the insurance on this one was for 1 year. So if it is $1,200 for 1 year accident insurance policy, it means that 1 month's worth of insurance is $100. So every month that we will be using this insurance, the prepaid insurance will have to be recorded less and less. So every month I will have to reduce it through credit account $100, and by the end of the year there will be zero balance on the prepaid insurance. However, we will increase the we will increase the insurance expense account by debiting it. So this is a second type of the example of the accounts that we will deal with. Let's see what else. And now in our this example here, we had $15,000 in note payable, but we also have 12% on that note payable. So we will also have to make adjusting entries addressing the issue of that 12% of interest expense and payment of that interest. Choose we to pay it on the go. So we will address that as well. So these are all adjusting entries that need to be analyzed and studied. And so we will start with the two types of those entries, adjusting entries. We call them deferral and accrual, and next we will talk about those. So these are the adjusting entries we need to talk about. We have deferrals and accruals. Now here we have to sort of remember the distinction between these differences. So deferrals, simply putting it, are prepaid expenses or unearned revenues. As we know, unearned revenues are what we call prepaid um, to us, prepaid by the customer, by the customer, um, sort of, for sales or the services that are yet to be provided. So I just say that just try to remember the deferrals by the keyword of prepaid. So it's either we have prepaid our expenses or the customer prepaid to us for services or sales that hasn't happened yet. Whereas the accruals, the revenues that have happened but not yet paid for, not yet paid to us, or accrued expenses, we have incurred the expense but we haven't paid for it. Yes, right. So not so yet paid for uh, from us, yeah, by us. So that could be usually electricity bill, yeah, electricity. Usually it can come to us way too late, or let's say by the end of the month we know how much we've spent, but we don't know when the bill will come, so we don't have that bill yet, but we have incurred the expense. Yeah, so expense has already happened. The same can be for rent. Yeah, so some people pay for their rent not in advance but after the rent has been used up. These kind of expenses that we might have incurred but not yet paid for. Yeah, so either way, it can be either revenue that we have not earned, we have earned already, yeah, but not paid. Yeah, the revenue earned. The expense already incurred, yeah, expense incurred. So these are the differences, and at first I do understand that it might get a bit confusing. They might get confused at what exactly is deferrals and what are the accruals. But again, like I said, just stick to the fact that the deferrals are with the keyword of prepaid. Accruals are with the fact that you have not yet either paid or received the payment for. So these are the differences. Now moving on to the details of the deferrals. We've already talked about the deferrals in direct examples. So we had prepaid expense. Have we? Yes, we had prepaid insurance, prepaid, I think it was rent. So something for what a company had paid in advance for, but not has benefited from that use, yeah, from the use of that asset. Now, the prepaid expense, the prepaid expense is the asset for the company. Because I've paid for it, I haven't used that benefit yet, but I have paid for it. I have the right to be able to use that benefit. Whereas unearned revenue, also we've talked about it. I mentioned an example. It's when the customer paid to us in advance, but we as a company haven't provided the product or the service for that yet. So for us, it's going to be a liability. It's a liability that we owe the service or a product to the customer. We have received the payment but not have provided it yet. So these two specific types of sort of transactions we've talked about: prepaid expense and unearned revenue. Now, for example, let's go to more direct examples. We had supplies. We are not immediately sort of recording the usage of the supplies. And after the purchase, we don't right away use them. Yeah, so we buy them, we keep them, we probably use them slowly, bit by bit. But at the end of the period, we record what has been used. If you remember when there was the example when we had a sale, so someone immediately confused it and they said, oh, we have to reduce the inventory. Let's say that the sale has happened, sale occurred. What happens when the sale occurs? Let's say $5,000 worth of sales happened. Again, if it's a sale, it usually means that we sold some kind of inventory. But when we do the recording of this transaction, what we do is let's say if it's on cash, yeah, on cash sale. So what happens is we record cash, debit, yeah, 5,000, and not inventory, nothing else. We record sale account as credit, 5,000. However, we sold inventory. Originally we sold inventory, and in this time, at the moment of this sale, we don't record it yet. We don't deal with the supplies sort of account changes. Now, what happens is that, for example, a lemonade stand purchased $400 worth of lemons and spices, and these become our, supplies in the form of those, lemonade. What is it? Lemons and spices. Now, at the end of because eventually we don't sell the lemons and spices, we provide the service in the form of the lemonade. So we basically use this lemon and spices and then prepare those lemonades. At the end of the month, however, we had 400, and now we have used $150 worth of supply. So it means that eventually in our books we're supposed to we still have 400. Yeah, in the books still show $400 worth of supplies, but we don't have that anymore. So we have to make an adjusting uh, entry to show the reduction, yeah, of $150 worth of sort of supplies. So our books, yeah, our books should show not 400. Yeah, it has to show now $250 worth of supplies, and for that we will have to do adjusting entries. Yeah, so that's the sort of introduction to what is going to happen. A next example is absolutely, it's a depreciation example. Although we've done it in the earlier weeks, we still haven't done it in the shape of, entries to the debit and credit. So we will look at that. Now, accumulated depreciation is that contra account that comes in handy to help us to record the depreciation allocation of the cost of that asset. Now, let's say a lemonade stand buys a juice maker for $2,000, and that is supposed to last us 4 years. Now, there's zero salvage value, so we will have 2,000 divided by 4 years, $500 we will lose each year from that juice maker. Now we will have to make those records. We will have to make those adjusting entries, because there won't be a document coming into us saying that, hey, look, you have a reduction in the cost of your juice maker. So this is the reason why we call it an adjusting entry, and we will use an accumulated depreciation account to enter those $500. So we will have an increase in the expense, yeah, depreciation expense, depreciation expense will increase by debiting 500. Yeah, expense is a debit account, so it will increase in debit, and we will have a contra asset account called accumulated depreciation account, depreciation account, and that will be credited through 500. This is called a contra asset account because it has an opposite effect on our asset, and it is on the opposite side. Yeah, so usually asset accounts decrease through credit, but in this case we have to correspond it to our asset account and reduce its value through the credit side. Yeah, accumulated depreciation will increase through credit by entering 500 there, and every time we will, and this is the adjusting entry. Yeah, this is the adjusting entries that we are talking about when it comes to the depreciation example. The next example is insurance example. Also, we did review it. So a company pays $4,500 for the insurance policy 6 months, I guess, in advance. At the end of the first month, the company must recognize the insurance expense that has incurred in the first month. Yeah, so they paid, let's say, January 1 through June 30. Sorry, I think that's today. Yeah, so January 1 to June 30. This now we have, now is the end of January, so January, let's say 31, and the 1 month expense for 1 month has to be recognized. And how we recognize it? We sort of divide this total amount by 6 months. We get 1 month's worth of insurance, and we basically make a record into the insurance, yeah, expense account, Yeah, and if it was a, yeah, how much is it? Yeah, X amount, and then the other account will be prepaid. Insurance will get reduced. Insurance will get reduced through the credit side. So these will be the entries that you will have to make. And lastly, maybe not lastly, but another example is rent example. Again, it's very similar to our insurance example where we pay in advance 8,000 for 4 months. Yeah, for 4 months. After the first month, we have to again recognize it. So when this payment happens, we record prepaid rent. Yeah, so we have prepaid rent of 8,000 to the debit, and cash, for example, is credit into 8,000. Now that 1 month later, we have to reduce the prepaid rent to 2,000, not yen, sorry, dollars. So what do we have here is a rent expense increases $2,000. Now we have spent, so we have to recognize it. However, our prepaid rent reduces $2,000.